Lesson 2 about ledger accounts. We've dealt with books of accounts, namely 7 books of accounts: journal, cash book, petty cash book, and 4 day books, i.e., sales day book, sales returns book, purchase day book, and purchase returns book. Each of these books are journalized, and the journal is posted to the ledger. So today we are going to look at the ledger accounts. In the main, there are as many accounts in the ledger as we have income, expenses, assets, and liabilities. So if we think of assets, this is buildings and what the main contents of the buildings are, i.e., furniture, fixtures and fittings, equipment, etc. In the factory context, we talk about plant and machinery as also a fixed asset. Finally, within the fixed assets, we have motor vehicles, and that is a group of fixed assets which, for each one of them, there will be a ledger account. In addition, we have current assets, and usually we talk of current assets in the reverse order of liquidity. So one of the first current assets we talk about is prepayments, which is when we have paid money in advance. For example, insurance will be paid in advance, and as and when your accounts are due for the accounting date, then you work out how much of the insurance is prepaid, and that amount will belong to the following year. So we have a prepayments, and this is then followed by debtors, which is the people who are customers and owe you money. And after debtors, we look at the bank balance, and finally cash. So those are the 4 current assets accounts. And then we also have current liabilities accounts, which the first one is accruals, followed by creditors, and creditors being people, suppliers to whom we as a business owe money. And after creditors, there is bank overdraft, i.e., you have overdrawn at the bank, and that balance at the end of the year will be shown in the accounts as a current liability. We then talk of long-term liabilities such as bank loan or any loan that is repayable after more than 1 year. And finally, we come to the capital. So capital is when we have the person starting the business would have invested in capital, and that capital will grow as the business makes profit. So technically, profit is added to the capital account, and if the businessman takes any money out of the business for its own purposes, then we call it drawings. So there is a separate account called drawings. Now all these accounts together, we talk of them as main ledger, sometimes referred to as nominal ledger. And if we were to look at these accounts, then we talk of them as impersonal accounts. Impersonal being the accounts that haven't got any addresses attached to it. So to summarize, we talk of assets accounts, liabilities accounts, and capital account. And within the asset account, we had debtors, and within the current liabilities account, we had creditors. So sometimes the main ledger is subdivided into a subsidiary ledgers, and within the subsidiary ledgers, we talk of sales ledger that deals with the customer's account, and we talk of purchase ledger, which deals with suppliers or creditors accounts. So each one of these accounts in the personal ledgers are controlled by what is known as sales ledger control account, which is a control account for all your customers' account. And we also have a purchase ledger control account, and that controls all the suppliers' accounts. So to recap, each supplier will have a separate account in the books of account, and also each customer will have an account. But all these accounts together are entered in the control accounts, and the control accounts are in the main ledger. So as far as ledgers are concerned, we only talk of one main ledger, and any subsidiary ledger are part of the main ledger. So customers accounts and suppliers accounts we talked about. Now all these ledger accounts are balanced, and the balances are brought down and listed, and that list is called a trial balance, i.e. a trial balance will have balances, either debit balance or credit balance, of all the accounts that make up the main ledger. The trial balance, usually if it's if the bookkeeping is correct, then the trial balance, debits and credit must be equal. So debit columns equals the credit column. However, this is not always the case, and there may be differences and errors, and we will look at the errors in bookkeeping as a separate subject. So to recap, we have books of accounts, which are primary records that the business must keep. Those primary records are then summarized and put into the main ledger, which we call secondary accounting, and from the main ledger there is a list of balances, which is the trial balance. Thank you.